people will buy whole life select for the death benefit. So just don't think these focus areas are set in stone. So when, all whole life companies had to go through the 7702 product guidelines in 2019. We had to update our products in 2021. And when we updated our products, the first thing that we did, we put a non-forfeiture rate, or the guaranteed cash value rate, at 3.25%. This is higher than most whole life companies in the industry. Not all of them, but most of them. This is going to be higher. So it really leads to more guaranteed cash value compared to other companies that have more. They might have more non-guaranteed cash value, but our guaranteed cash values are always going to be really strong. The PUA load, so that's when you're overfunding the policy, adding paid up additions. It's also something that stands out in the industry. It's one of the lowest out there. It's 6%. So if you put $1 in as a paid up addition, 94% of that dollar, or 94 cents, is going to be going towards cash value. So a great way to overfund a policy, especially if you're using it for the living benefits of whole life insurance.
I have a question.
Yeah, go ahead.
The guaranteed cash value rate is at 3.25%. Is that the floor or is that the cap?
So that is set in stone.
Sounds strong. Okay.
So that is what it's going to be. And I should have said this, I forgot to mention this. That is the gross number. It's not going to be the net number. So the costs are going to come out of that interest rate that's growing. But we cannot change that whatsoever.
Okay, thank you.
And then the current loan effective rate, and this is variable, it changes month to month, is currently 5.48. So you could take a loan against the policy, and we would loan out cash value at a 5.48% rate. So, with interest rates going up, that loan rate has gone up a little bit, but still very competitive in the marketplace. So we are also a non-direct recognition company. There's not many of us out there anymore. There's 5 or 6 whole life companies that are still non-direct recognition. So what non-direct recognition means, you have a policy with us, client wants to borrow some funds, or use their policy for a loan. We're not actually taking money out of the policy to use that loan. We're putting a lien against the policy. So One America is loaning out the cash value, putting it a lien against the client's policy. But no matter what, if the client pays back that loan, the policy will go back just to the same as it was if there was never a loan taken. So, in here, this example, I ran an illustration with the client taking out a $20,000 loan. I'm sorry, $40,000 loan in this case, and repaying it back over the course of the next 5 years. And you'll notice, with the loan taken or the loan not taken, the cash value, once it's repaid, the cash value and the death benefit will go right back to where it was. So we don't change a policy just because you have a loan against it. You're still paying the same dividend, the cash value is still growing the same. It's just being able to take the money out and put it back in, and the policy will go right back to where it was supposed to be. So if you guys hear, infinite banking, or, being your own banker, this is why people love non-direct recognition companies, because they're able to take those loans out, use the loans for another money-making, investment, and then be able to pay back the loan, and there's no difference in the policy. These next, I'll go over the riders, and we have a lot of riders in our whole life policies, kind of a blessing and the curse of them. But these are the ones that are automatically included into all our whole life policies, except for one, and I'll mention that one that isn't in all our policies. It's only on our whole life select policy. So the index dividend option. So this is something that's pretty unique in the industry, and it's basically betting your dividend on the S&P 500. So you have the potential to double your dividend on the contract. And the nice part about this, it comes free with policy. It's up to you and your clients if you want to use it or not. So you can allocate up from 0 to 100% of your dividend into the index dividend option, and you can change that every policy anniversary. And kind of how it works is what we call the DMR is 13%. So that's the dividend maximizer amount. So if the S&P 500 does 13% or higher, your client will double their dividend for the next year. Now, kind of the risk that comes in with this is if the S&P 500 isn't over 13%, then we're getting into portions where we're going to still either gain portion of the dividend or not. So if the S&P 500 did 9.75%, the multiplier would be 1.5. If it's 6.5, you would just get your dividend for the next year that you were going to get anyway. But if it's lower than 6.5, then we start actually losing portions of the dividend. So at 3.25, it only pay out half the dividend. And if the S&P 500 is 0 or negative, the client would actually lose their dividend for the next year. So some people love this because it offers the ability to add more cash value, buy more death benefit. But some people don't like it just because that's not what, they say, I want to buy a whole life for the guarantees. I don't want to buy a whole life for, a risk that's built in. But I really like it for younger clients because you have that ability to really maximize the growth over the long portion of it. And when you illustrate this on the illustrator, it's going to show the dividend at over 17% when you're actually illustrating it in our illustration. So this is kind of just showing the I do in action. So this is over a long period of time, you'll see that, for someone that purchased the policy at age 35 and age 45, there's not going to be much difference in cash value. But as the time goes by, the cash value really grows higher with the index dividend option included, because that dividend really has time to grow and really multiply itself even further. And what other questions on that? Because it is a very unique.
I have a question.